Hi guys, welcome back. If you're new here, my name is John and this is Talk Finance. Today I wanted to talk about the top 10 monthly dividend paying companies according to an article from Simply Safe Dividends. In this article, they list all 60 monthly paying dividends, but 29 of those monthly paying dividend stocks don't have a few things such as dividend safety scores, a dividend history, or trade over the counter, making them inappropriate for most investors. So I took their top 10 rated monthly dividend paying stocks and analyzed them to see if they really are the best monthly dividend paying stocks. I also wanted to verify that the information was correct and be able to go more in depth on the stocks than the overview they provided. Before we get started, I would really appreciate it if you hit the like button. It helps out the channel and it lets me know that you enjoyed the video. Also, if you found the information useful, consider subscribing. Okay, let's get started with number 10. Phillips Edison, ticker symbol PECO, which is considered a real estate investment trust or REIT, was founded in 1991, but keep in mind it just went public in 2021, so you can see why it has only been paying dividends for 1 year. They currently own around 200 grocery anchored shopping centers located in secondary or suburban markets with the Sun Belt region, driving roughly half of the rent. Grocery chains such as Kroger, Publix, and Safeway account for around 1/3 of PECO's rent, providing a stable source of cash flow and reliable foot traffic for surrounding tenants, none of which account for more than 2% rent. They are currently trading at $32.76 a share. Since going public in July of 2021, they are up 17%, but if we look at their share price over the past 1 year, they are actually down 3.79%. That's not too bad. So if you bought right when they went public, you would be up in both share price and dividends, especially if you reinvested those dividends. I took a look at their fourth quarter 2022 earnings release and future projections, and it was quite informative. They currently have 97.4% lease portfolio occupancy, 15.8% core FFO growth, which is very important for a REIT, and a $48.3 million net income attributable to stockholders. They listed that they have a 92% portfolio retention rate, 14.6% renewal spread, and 1,001 leases executed. They also saw U.S. grocery sales growth in 2022 of 8.3%. They currently pay an annual yield of 3.42%, which translates to a monthly dividend of 0.0933 cents or 9 cents a share. Their market cap is $3.84 billion. They sound like a company with a lot of potential, especially since 70% of Phillips Edison's tenants provide necessity-based goods and services, and that provides some insulation from the continued rise of online shopping. But I am not convinced yet on this company. I do think it could be a good investment in the long run, but they don't have enough public information for investors, or a dividend history that can prove they are able to pay their dividends for a long period of time, or even be able to increase their dividends over time as well. Most analysts are also telling you to hold the company, and they are giving it a price target of in between $32 and $46 a share. For the price, there is better and more secure companies out there, but if you want to take a risk and diversify your portfolio, this REIT could be one that could see a large dividend growth in the future. I'm just not looking at buying this REIT since I'm already diversified in other REITs on this list. I am not going to tell you what is right for your portfolio, but I know this one is not the right investment for me. Number 9, SLR Investment Corp, ticker symbol SLRC. They are in the BDC sector or business development company. They were founded in 2007. The company went public and was listed in 2010. They invest directly and indirectly in senior secured loans of private middle market companies to generate current income that is distributed to shareholders monthly. They collaborate with U.S. middle market businesses across a diversity of industries to deliver customized debt financing solutions. They are currently working with about 700 companies across more than 100 industries, and they aren't overly dependent on any single investment with an average exposure of just 0.1% of the total portfolio. Also, I would like to mention that SLR's investments are first lien secured loans. That means that these securities are paid first when a borrower defaults and gives SLR the right to seize property if its loans are not repaid, reducing the risk of major loan losses during a recession. They are currently trading at $15.35 a share, with an annual dividend yield of 10.68%. which translates to a monthly dividend payment of 13 cents, or 13.66 cents to be exact. Their return since they went public in 2010 currently sits at a loss of 16%, and this past 1 year sits at a loss of 14% with a market cap of $833 million. They were paying a quarterly dividend until 2021. After that, in 2022, they started paying their dividends monthly. We all know business development companies pay high yield dividends, but this BDC wouldn't be my first choice to invest in. There are better BDCs out there that might pay a quarterly dividend, so they wouldn't be listed on here. They also haven't really raised their dividend since they started paying it. I will say this company has a lot of potential. They haven't missed a dividend payment since 2013 and have managed to keep their dividend consistent, so you won't see any fluctuations on your monthly dividend payment. Also, they are well diversified in the market and insulated as well. Number 8. Gladstone Land, ticker symbol LAND or Land. They are a REIT. Their goal is to build the premier farmland real estate company focused on the ownership of high-quality farms and farm-related properties that are leased on a triple net basis to tenants with a strong operating history and deep farming resources. All their farms have abundant water sources and are currently 100% occupied. I know I have said it before in other videos, but in case you weren't sure, a triple net lease is where the tenant pays all the expenses of the property, such as real estate taxes, building insurance, and maintenance. Some of the locations where they own land include California, Arizona, Oregon, Washington State, Texas, and Colorado, amongst others. They are currently trading at $17.11 a share, with an annual dividend yield of 3.22%, and currently pays a monthly dividend of 4 cents, or 0.0459 to be exact. They have been paying their dividend consistently since 2013, and although slow, they do show some dividend growth. If you bought some shares when the company went public, you would be up 14% in share price appreciation, and you would be up even more with dividends calculated into that amount. But when we look at the 1-year returns for the company, we can see we have a loss of 49%. That is a big loss, even with earning the dividends. The company's farms are leased to more than 80 farming tenants who grow about 60 different types of mostly specialty crops, rather than commodities such as corn and soybean. The leases run up to 10 years. I think this REIT isn't going anywhere anytime soon, especially with the need for food and the government pushing for more food to be grown locally instead of importing from other countries. I do still think that there's a higher than normal risk involved with this REIT. With vertical farming growing, it will be competing with this market, and I don't see a lot of price appreciation since the company went public. But that big hit the company has taken this past year can leave a lot of room for upside on the stock price. I mean, look at what analysts are rating the company. They are saying buy, with a price target between $21 and $36 a share. What are your thoughts on Gladstone Land? Are the dividends worth the share price risk? Number 7, Gladstone Investment Corporation, ticker symbol GAIN. They are a business development company, and if you are into dividend paying companies and retiring early, you might have already heard about them. They are a private equity fund focused on acquiring mature middle market companies with $20 to $100 million in revenue, attractive fundamentals, and strong management teams. Investing alongside both management teams and independent sponsors, GAIN typically provides most, if not all, of the equity and debt capital required to close a transaction, which greatly increases certainty and speed of closing. Additionally, as a publicly traded fund, they differ from other private equity funds in that they have no partnership end-of-life deadlines and can provide truly patient long-term capital. Equity investments are riskier, but the firm bases its monthly dividend on interest income earned from its loan portfolio, which consists primarily of first lien secured debt that gets paid back first if a borrower defaults. GAIN went public in 2005 and have been paying a consistent growing dividend. They currently have an annual 7.18% yield and pay an 8-cent a share per month dividend. Their return since inception is currently at a loss of 11%, and their 1-year return sits at 8%, at a loss of 8%. Keep in mind that these companies pay a high yield for that reason. They know there won't be much return when it comes to a share price, but pay you a higher yield to make up for that in return. The thing is finding out if the dividend is worth the loss of share price, since there is other BDCs out there that have been able to maintain share price growth and dividend growth as well, and I know we will cover at least one of those BDCs higher up on the list. GAIN only has a portfolio of 25 companies spread across just over a dozen industries, providing limited diversification compared to many of its peers. However, management participates on the boards of its portfolio companies to help drive value creation and takes a long-term approach, investing in less than 60 companies since GAIN went public in 2005. Number 6. TransAlta Renewables, ticker symbol TRSWF. Rolls right off the tongue. They're in the utility sector, more specifically, renewable electricity. TransAlta Renewables website says that ESG is more than a business strategy at TransAlta Renewables. It's a competitive advantage, and we place strategic focus on our environmental, social, and governance performance to balance our bottom line with our impacts on people and the planet. TransAlta Renewables was created in 2012 to own a portfolio of power generation facilities by parent and sponsor TransAlta Corporation, which owns around 60% of the firm. Today, TransAlta Renewable owns or has interest in around 50 power generation facilities focused primarily on wind and natural gas assets, with hydro and solar facilities accounting for a much smaller portion of cash flow. They currently have an average contract length of 11 years. The firm's facilities generate predictable cash flow from fixed-fee power purchase agreements with creditworthy customers such as utilities and industrial companies, which buy the energy TransAlta generates. They have been paying consistent dividends since 2013 and currently pay a monthly dividend of 7 cents or 8 cents when rounded up per share. They currently trade at $8.59 a share and are down since inception by 12%. And in the past 1 year, they are down by 40%. So there has been some major price depreciation in the share price, but they have made up for it with a consistent dividend payout and high dividend yield of 7.99%. I will say their dividend growth has been slow and hasn't changed much in almost 6 years. Analysts are giving this company a hold, giving it a price target between $7.95 and $11.21. So compared to a few other stocks in this list, there isn't much price appreciation to look towards. They currently have a cap ratio of $2.3 billion and a trailing 12-month PE ratio of 30. Its 52-week low is $7.88 a share, and 52-week high sits at $18 a share. Number 5, RioCan, ticker symbol RIOCF. Most companies on the list are based out of the United States, but this REIT, just like our previous stock on this list, is a Canadian company, but this is one of Canada's largest REITs. RioCan owns, manages, and develops retail-focused, increasingly mixed-use properties in Canada's major markets. It currently owns 200 shopping centers and mixed-use properties located in large, high-density markets such as Toronto, Ottawa, and Calgary. Just over half of the company's revenue is derived from grocery-anchored shopping centers, which provide a consistent source of foot traffic for adjacent retail tenants. In total, management estimates that around 85% of the mid-cap REITs rent comes from tenants with stable rent paying ability, strong covenants, and sustained foot traffic. RioCan has been paying solid and growing dividends since 1995 until 2021, when they had to cut their dividends because of the pandemic. But they did not skip a payment. They also have managed to stay consistent, currently paying a monthly dividend of 6 cents a share. They are currently trading at $15.50 a share. Looking at their price appreciation history, we can see that since 2008, they're up 12%. That's right, this company is in the positive when it comes to share price appreciation. But in the past 1 year, they are down 20%. They have a cap rate of $4.73 billion and a trailing 12-month PE ratio of 27, but a forward PE ratio of 12. They have a 52-week low of $12.98 and a 52-week high of $20.63 a share. And analysts are saying there is more room for growth, making the company a buy, with a price target between $16.99 a share and $18.80 a share. I don't like when a company cuts their dividend, but I have to give them a round of applause for paying a dividend consistently for over 25 years. They're a company that I don't have in my portfolio, but will be researching some more about to see if it's something I would like to add in the future. But as of now, there's other companies that I'm more interested in, such as our next one on the list, Stag Industrial. Ticker symbol STAG or STAG. If you have seen my channel before, you know I have purchased a lot of shares of Stag since 2021, and although I haven't purchased any recently, I have been looking at their current share price and thinking about purchasing some more while it's at these prices. I have made a video about Stag before, so I will keep this one brief. If you want to see the video after you finish this one, you can find it on my channel. I will also add the link to this video. If you are new to Stag Industrial, They are a real estate investment trust focused on the acquisition and operation of industrial properties throughout the United States. By targeting this type of property, Stag has developed an investment strategy that helps investors find a powerful balance of income plus growth. Stag currently has an enterprise value of $8.4 billion. They have 111 million square feet of rentable space. They are located in 41 states and have 562 buildings. They also just released their earnings, which I made a video about as well, and they beat their revenue and FFO, which is more important to a REIT than EPS. Stag has been paying a slow growing but consistent dividend, which currently sits at a 4.51% yield and a monthly payout of 12 cents or 12.25 cents a share. They are down this week, sitting at a share price of $32.62. But look at that great price appreciation since they went public in 2011. A 166% increase. Although their 1 year sits at a loss of 17%, I purchased them in 2021 and have dollar cost average into Stag, so you can see that even recently, in the past 5 years, they are still up 36%. Number 3, Agree Realty, ticker symbol ADC. No, not the band. They are a real estate investment trust as well. They own 1,839 properties, most of them freestanding, single-tenant properties leased primarily to national retailers with investment-grade credit ratings. Some of the mid-cap REITs' largest tenants include Walmart, Dollar General, Best Buy, TJ Maxx, and CVS. No tenant exceeds 8% of rent, with only Walmart topping 5% of ADC's revenue. They also diversify across retail industries, with none accounting for more than 10% of rent. They try to focus on essential businesses that would be more resilient to e-commerce, such as a tire and auto service, grocery stores, home improvement, and convenience stores. They have been paying a dividend since 1995, but they started paying their growing dividend monthly starting in 2021. They have been consistent and have also managed to grow their dividend to what it is now, 24 cents a month per share. And just like Stag Industrial, you can see a nice return since inception. Keep in mind, this is a monthly dividend paying company in their REIT, so a large price appreciation is not expected, but they still have a 255% increase, and even in the past 1 year, they are still up by almost 8%. I think we can all agree that Agree Realty is a solid monthly dividend paying company that anyone would like to own. We can see even analysts have listed ADC as a strong buy with the price targets in between $73 and $85. Their share price sits at $69.40 a share, and they have had a 52-week low of $60.18 a share and 52-week high of $80.44 a share. Most REITs that have a price appreciation over time tend to stay in between a certain price point, and it seems Agree Realty does that. I will definitely be doing a more in-depth video on them and possibly adding them to my portfolio pretty soon. Number 2, Main Street Capital, ticker symbol Maine or MAIN. They are a business development company and one that I own in my portfolio and have talked about in my channel. It's also the only BDC in my portfolio. If you want an in-depth analysis, you can also go to my channel to see more about it. I will also post a link in the video. Go watch it after this. They have helped 200 private companies grow or transition by providing flexible private equity in debt capital solutions. Privately held businesses turn to us because we are Main Street, not Wall Street. We build relationships and tailor transactions to meet the unique needs of our portfolio companies and their owners. Main Street Capital has been paying their dividends consistently since 2007 and have consistently been raising it after 2008. They currently pay a monthly dividend of 22 cents a share, and their annual dividend yield sits at 6.85%. Their share price was as high as $42 a share this week, but its current prices as of close Thursday is $39.44 a share. Its return since inception in 2007 comes out to 162% return, and in the past 1 year, they are down 2.4%. But if you have had this company even this past year, you are most likely up on your investments since they have a nice payout. They had a really nice earnings report showing that the company is aggressively growing, and they came with a big beat for the EPS and revenue for Q4 2022 earnings. In their earnings call, they talked about making sure they have a reliable, consistent dividend payout for shareholders. And as much as they want to grow their dividend as high as it can go, they want to focus on sustainable dividends and paying out the excess as a bonus dividend, which they will be doing in June. They announced an extra 17 cents a share bonus dividend. Well done, Main Street Capital. Now get ready for number 1. The number 1 monthly paying dividend stock according to Simply Safe Dividends is Realty Income, ticker symbol O. I also own this REIT. It's interesting, out of the top 10 listed here, I own 3 of the top 4 listed. I have made a lot of videos on O, so if you want a more in-depth review, feel free to click on the link in this video or find the video on my channel. If you have been a dividend investor or have been thinking about becoming a dividend investor, then you had to have heard of Realty Income. It's one of the best known dividend payers out there. They are considered a blue chip stock and considered one of the best stock purchases you can make. They own over 11,000 properties and have more than 1,000 tenants. Realty Income generates most of its rent from tenants that have service, non-discretionary, or low price point elements to their business, providing some insulation from e-commerce, and nearly half of its tenants have investment-grade credit rating. They are considered a dividend aristocrat and have been paying their dividends for over 27 years. They are known for naming themselves the monthly dividend company and take pride in that fact. They have 632 consecutive monthly dividends and have increased those dividends 101 quarters consecutively. They pay a current dividend of 25 cents a share and have an annual dividend yield of 4.81%. They are a large company with a market cap of $41 billion and have always been expanding, but recently started expanding into different markets, including vertical farming and purchasing 415 retail locations from another company. I also link those videos above in this video. What are your thoughts on these companies? Do you own any of the 10 companies listed in this video? I wanted to thank you for watching this whole video. I know it was long and hope you found it informative. Consider following the channel by hitting the subscribe button, and if you enjoyed the video, hit the like button as well. It helps out the channel and I would appreciate it. See you on the next one.